Hi everyone, happy Friday Money Wind Up. You may have noticed that some of the fixed rates are rising within some of the banks. I thought we might talk a little bit about that. Fixed rates are rising because the banks expect higher future rates. So they're safeguarding themselves. Fixed mortgage rates are basically a prediction of where interest rates will go, not where they are today. So recently in Australia, major lenders started lifting fixed rates late 2025 and early 2026. Some increases have been significant. For example, a 0.7% jump on a 3-year fixed rate at one major bank. This happened even before the RBA moved because banks were pricing in expected rate hikes. And the RBA has already nudged rates higher in 2026, with economists thinking another small increase later in the year. Translation? Banks think the lower rate cycle may be over for now. Something you probably don't think about is that bond markets are what is pushing fixed rates up. This is the technical thing that most borrowers don't actually see. So banks fund fixed loans on government bond yields over a 2 to 5 year period. When those yields rise, the bank's funding costs go up and fixed mortgage rates rise with it. Bond yields have climbed significantly since the late 2025 as the markets began expecting a tighter monetary policy. So what does this mean for you as a homeowner? There are a few practical implications. For people on variable rates, repayments could increase later in 2026 if the RBA continues hiking. But increases may be gradual, not the rapid hikes that we saw in 22 and 23. So for people thinking about fixing, the window for ultra-cheap fixed rates is likely closed. Banks raising fixed rates usually signals that they expect higher or stable rates, not big cuts. So for borrowers rolling off old fixed rates, this is still the biggest stress point. Many people who fixed at 2% or just over 2% during COVID are moving to 5 to 6% loans, which can add hundreds per month. The big picture trend right now, the market view is roughly inflation is still sticky, economy is holding up better than expected, and the RBA is willing to tighten it again if they think it's needed. So lenders are acting cautiously and pricing mortgages higher in advance. Quick takeaway from it: rising fixed rates are usually an early warning sign that the market expects interest rates to stay higher for longer or possibly rise further. So many borrowers are thinking, rates might go up, but they might also come down. If I fix and rates drop, I'll be stuck. So they sit on variable and wait and see. So people are still hesitant to fix right now because fixed rates aren't that attractive. In many cases, the 2 to 3 year fixed rates are similar or even higher than variable. So when that happens, a lot of people think, why lock in if I'm not getting a discount? They still remember the last fixing mistake. Fixed at 5.5 to 6 in 2023 to 24. Then watched variable rates drop. Economists are thinking one more hike could be possible. Cuts could start late 2026 or early 27. Banks lifting the rates usually means they don't expect rates to fall quickly. What you need to think about is, why do you want to fix? Is it that you think, man, I know how much I can repay and I'm happy with that repayment. If I fix it now, then I know exactly what I'm doing. If I don't fix it and the rates go up, am I going to struggle? There's always a reason to fix your home loan rate. If you're interested in doing something like that, then you probably need to talk to somebody. The one thing to watch, and this is the real signal, if fixed rates start dropping while the RBA hasn't cut yet, that's when borrowers suddenly rush to fix. That means the market believes cuts are coming soon. But we're not there yet. So everybody, have a great weekend. Happy Friday Money Wind Up.